Hey, what's up, everyone? So, of course, last week we took a look at some stocks that Ray Dalio has been buying this year. But this week, we're taking a look at another really famous investor, perhaps more of a bit of a trader. That is in Steve Cohen, who is well known for not only being the owner of the New York Mets baseball team, but also for being one of the richest, most successful stock market traders of our lifetime. In fact, Bloomberg once called him the most powerful trader on Wall Street, and to this day, he continues to lead one of the biggest hedge funds out there in the world in 0.72 asset management, which currently holds a record more than $32 billion of assets under management. In fact, this past year, Cohen was so successful in raising investor capital that they literally had to stop allowing people from investing with the hedge fund so that they can just maximize the return for their already existing current clients, which is kind of crazy, to have so much demand given the weak macroeconomy, yet you have all of these investors and rich elites wanting to invest with Cohen or through Cohen because of, his ability to beat the market and generate big returns. So anyway, in today's video, we got to take a look at what stocks he's been buying. His hedge fund had to report to the SEC all of their stock purchases from last quarter. We're going to take a look at the 5 largest purchases, and I'm going to rank them from best to worst. I'll give you my own opinion on each one of them too. It's always fun to do these videos. Hope you're enjoying them, but let's just go ahead and jump straight into it. All right, now sorting these 5 purchases from smallest to largest position in the portfolio. Well, purchase number 1 is going to be Edwards Life Sciences, ticker symbol EW, which was a brand new addition to the portfolio at over $280 million worth of stock. And by the way, all of the purchases that we're going to run through today, they were big ones, big increases, but this was a brand new addition. And even though it's worth so much money, close to 300 million, well, it's still only worth less than 1% of the overall portfolio because it's just so massive. Anyway, now if you've never heard of this company, well, EW is a medical device specialist, particularly producing them for heart disease and critical care monitoring. In fact, they really pioneered the transcatheter heart valves, what we call TAVR, that don't require the patient to have open heart surgery for using them. Well, this year in particular should see a big rise in sales thanks to their next gen version of that called Sapien 3. That is made from cow heart tissue, and it features anti-calcification technology. So it's a bit of a big innovation there, the big upgrade that they're making to it. Now, the company also makes systems for monitoring a patient's heart functions, and it's also been one of the most popular choices in healthcare for being an all-in-one AI-enabled platform. Anyway, the company has benefited from these innovations, especially in recent years, given the rising age of large populations, like, for example, the baby boomer generation, as heart disease is sadly the #1 cause of death in America. And as such, EW projects a double-digit rise in both sales and profits each year for the foreseeable future. So it looks like Cohen, sees the opportunity there to invest in something that is going to be generating some substantial growth. Now, whether that turns out to be, exactly 100% accurate, totally true or not, well, we'll have to wait and see. But at the moment, the stock is performing pretty well with over 16% gains so far this year. However, from the top, this normally strong performing stock is actually down about a third of its value. And look, I would agree that right now is probably a good time to buy on that dip given how strong the company is and, their projections for the future. But the only reason why I don't think I'll be adding any of it myself anytime soon is because, well, number 1, the valuation is pretty rich, trades significantly higher than the sector on most metrics. And number 2, I already own a rival that I like much more in Medtronic, which is the biggest medical device producer in the world, who not only has a much cheaper valuation, over 20% lower than the sector, and over 50% cheaper than EW, but it also has one of my favorite dividends out there with over a 3% yield and close to 5 decades of consecutive growth. EW does not pay a dividend by comparison, and while I might like them for other reasons, I'm still going to have to rank them around the middle for now at number 3, since I don't think I'll be buying any of the stock myself anytime soon. Moving on to purchase number 2, though, we have a gigantic increase of over 1,400% in the media giant Fox Corp, ticker symbol FOXA, bringing the stake up to over $300 million, which was actually a new addition in the prior quarter, making this still a fairly new position for Cohen too. Now, Fox is, of course, well known for their TV properties, their Fox News Media, and also Fox Sports. But if you're not aware, they actually used to be a lot larger before Disney acquired much of their assets and brands in the 21st Century Fox deal, which resulted in this now smaller Fox Corporation kind of being spun out from that back in 2019. Now, since then, Fox has still maintained leadership in several areas, notably in broadcast and cable television, where the Fox News channel continues to be the #1 most watched television news channel for over 2 decades in a row, while the entire news media group also reaches over 200 million people every month. Now, Fox Sports is also very popular and capable of reaching over 100 million people in a single weekend as well, while Fox Entertainment continues to broadcast many popular shows like The Simpsons, a couple Gordon Ramsay shows. They acquired the animation studio behind Bob's Burgers. They have TMZ, the Masked Singer, and a lot more. In total, though, Fox TV stations also own and operate close to 30 full-power broadcast stations in the US, and they also have a growing online streaming presence as well, which includes, by the way, their acquisition of Tubi. It's a popular ad-supported platform that has even grown to more users than, get this, Max, Peacock, and Paramount Plus. That's pretty crazy. As good as all of that is, though, performance has actually been pretty choppy, with profits declining these past couple years by about half the amount that they did in 2021. And although sales have at least risen during that time, they're now falling by over 6% this year before expected to return to growth next year. Now, much of that is because of course, regular television declining for years now, with people kind of cutting the cord and switching to online streaming, which is also a very competitive landscape for them too. And while I do think that Fox does have a lot of content that can be used in their own apps or even be licensed out to other platforms, well, I would just rather get my exposure to video entertainment through much larger, more diversified companies like, maybe Disney or even Amazon, that I feel are much lower risk. I mean, take Amazon, for example. They've been doing pretty well with Prime Video, especially after acquiring MGM, which helped them produce the hit new Fallout show, which has been very popular. And again, they're a much larger, more diversified, and just overall safer company to invest in, at least in my opinion. But Fox, on the other hand, has actually seen their stock price continue to fall ever since the spinoff. And while that does at least give them a super cheap valuation, I just think there's safer options out there with more growth opportunity, and for that reason, I'll have to rank them pretty low here at number 4 because of it. Moving on to purchase number 3, though, we actually have a much better stock in my opinion, arguably one of the best value stocks in the entire market right now, and that is the digital payments leader PayPal, ticker symbol PYPL, which Cohen increased his position on by a giant more than 800% in the quarter, bringing the stake up to over $300 million. And yeah, I can clearly understand why he would choose to do that, as PayPal has now fallen by over 80% from the highs that they reached during the pandemic to now one of the lowest prices in their entire history. Now, valuation-wise, you can't really judge them compared to the sector because, finance usually contains very cheap bank stocks, but compared to fintechs at least, PayPal is actually very cheap and over 60% lower than their own 5-year average as well, which at a PE ratio of only around 12 to 14, you're just not likely to find that kind of value among fintechs. And yet PayPal is actually the leader of their respective market with over 45% market share in payment processing technology, according to Statista. Now, the company has also been solidly profitable for years, and while growth has been the biggest concern coming off the pandemic, where free cash flow has now been stagnant for years too, well, they are at least generating around $5 billion of that every year, which, by the way, most of that is being used to buy back a ton of their own stock while it's still currently low, which I do strongly agree with. Unfortunately, though, we did also see revenue growth fall from a double-digit rate in 2021 to now a single-digit rate going forward, as it's just a little harder to grow in this environment coming off the pandemic, which on top of that, investors are also worried that the market is getting more heavily saturated with competition like Stripe, like Square or Block, and there's even indirect players like Google Play, Apple Pay, and even Amazon Pay, which is where I like to get most of my exposure to those markets. I own all 3 of those, Google, Apple, and Amazon. I will also say, though, that I actually did pick up some of this stock this past week for our community portfolio after running a poll where I asked you guys which new stock should we add to the portfolio, to which over 40% of the votes actually went to PayPal, and by a pretty large margin too. So I think you guys are seeing the same value here mixed with turnaround potential given the rising markets of digital payments, e-commerce, and even online advertising too. And that's something that I see as well. And by the way, it's not just us that feel this way, but also many analysts who have price targets well above where PayPal currently trades today. Anyway, I think this stock is mostly a buy here, so I'm gonna rank it pretty high at number 2 and above everything else that we've seen so far on this list. With that said though, we are now down to the final 2 stocks of the list, and coming in at purchase number 4, we have the telecommunications giant AT&T, ticker symbol T, which Cohen more than doubled his position on this past quarter, adding millions of more shares and bringing the stake up to well over $400 million worth. Now, when it comes to AT&T, I actually used to really like them myself and was even heavily invested in them before I switched for their biggest rival in Verizon. But the reason why I initially liked AT&T was for their strong cash generating business in telecom, which they were able to use to pay a huge dividend, and they even had a little diversity too, pushing into video streaming through HBO Max. However, much of this bullish thesis started to erode over time as the company was riddled with massive debt from the giant acquisitions of DirecTV, which, by the way, they paid a whopping $67 billion for, including debt, only to later spin it off for just $16 billion. And they also acquired Time Warner Media, which they paid over $100 billion for, only to later spin that one off too, resulting in a $47 billion loss, and also no longer having video streaming, that service, what we call Max now, to show for it either. As a result of these and many other mistakes, so AT&T's financial growth has been pretty much flat, while also being forced to cut their dividend by almost half, which had previously been increased for 35 years in a row before being cut. Now, that's not to say that it's all bad news here, as the dividend still yields over 6%. They continue to generate billions in cash flow, and that's both operating and free. And even though their business is less diversified now, well, telecommunications at least continues to be a cash cow for them, and that's something that I don't think is likely to disappear anytime soon. Plus, the stock is trading near a decade low with a dirt cheap valuation, around 40% cheaper than the sector. But the only reason why I still refuse to buy the stock myself is because I just like Verizon a bit more, namely for their higher quality business, as they've consistently won more quality awards for decades, which I do feel gives them a competitive edge. Plus, the stock is just as cheap with also a fantastic dividend. And so while I can see why someone might want to pick up AT&T for that value, I just prefer Verizon a little bit more myself. And because of that, I'm going to have to keep PayPal ahead of them and push it up to the number 1 spot so I can fit this one in. With all of that said though, we are now left with the 5th and final purchase, which is also the largest position of the list, and that is none other than Broadcom, ticker symbol AVGO, which was actually another new addition to the portfolio. However, he did own it a few quarters prior before then selling out and now buying back in. So it's kind of like a re-addition here. Anyway, this turned out to be a great pickup because Broadcom has soared by even more recently after reporting very strong Q1 earnings where they beat on both the top and bottom line thanks to strong demand for their AI custom chips and services that they supply to other businesses. For example, analysts from Goldman Sachs had this to say: alongside NVIDIA, we view Broadcom as a critical piece to the ongoing AI infrastructure build out. And we reiterate our buy rating on the stock. It's kind of crazy, right? Comparing it to NVIDIA. We know how hot they've been. Also, we had Bank of America comment, and they said they also reiterated their buy rating, and they added that Broadcom is their top AI pick. How crazy is that? Because of its leading position to grow in custom AI chips and Ethernet networking, while also being able to upsell VMware to enterprise customers deploying AI. Which of course that's off the heels of that massive $69 billion acquisition of the virtualization, cloud computing, and even cybersecurity specialist, where they'll likely see now a ton of synergies within the two businesses being combined into one. Anyway, as a result, Broadcom has not only risen by almost 60% just this year alone, but it's also up over 550% in the past 5 years too. And yet its PEG ratio is actually just only slightly higher than the sector because of how even more profitable they're expected to become in the future, which I also strongly agree with myself, as Broadcom has been on fire these past few years with soaring financials on both the top and bottom line, while this year too is expected to see revenues climb by another 40% plus thanks to that acquisition, which even after that, they're still expected to rise by another double-digit percent next year as well. Now, I do worry a little though that this one might be a little priced to perfection at this point, given that the valuation is like 100% higher than their 5-year average. So I could understand perhaps ranking PayPal higher because of that. However, I actually own Broadcom stock myself in my personal portfolio, and I love what they're doing. So I just got to give them that #1 spot regardless. But there you have it, guys. This is my ranking list here. This is what I went with. And overall, not too bad of a roundup of stocks here being picked up by Cohen, in my opinion. I feel like there's a bit of a mixture here of value and growth and technology, which I'm always happy to see. Even though I wouldn't be buying most of these stocks myself, though, especially the bottom two, but the top three, I could definitely understand why someone would want to be picking those up. And yeah, I'm not going to disagree too much with this list here. What do you all think, though? I'd love to hear your thoughts. Do you own any of these stocks? Would you change my ranking at all? I'd love to hear your thoughts down below in the comment section. Thanks again for stopping by, my friends. Thank you for all your support. Hope you enjoyed the video, and I will catch you in the next one. All right, take care, everybody. Bye-bye.